Yeah. No, 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 no. Oh. Yeah, yeah. Gifted and grounded, 7-figure squad. We don't stop, we just thank God. Bright like balls, cool like frost. Peace on lock, no matter the cost. We plan, we lead, we build, we teach. We stretch, we serve, we stab, we reach. Joy in the fruit, not just the flash. We don't just spend, we pass it back. Yeah. Trim the tree, I trim the debt. No red in the books, just discipline say. Lights might twinkle, but pieces still. I don't chase hype, I chase as well. Cookies out, but the vision bakes. Quarter for a come with 7-figure stakes. While they care, I calculate grace. I get more now, it's part of the race. Mistletoe, now I'm locked on mission. Presents rap, but my focus different. Every gift they open nice. But what I do, gonna bless for life. Get there, ready and grounded. 7-figure squad. We don't stop. We just thank God. Bright like balls, but cool like frost. Peace on lock, no matter the cost. We plan, we lead, we build, we teach. We stretch, we serve, we stab, we reach. Joy in the fruit, not just the flash. We don't just spend, we pass it back. Yeah. Pints in air, my thoughts stay fresh. Candle light flicker while I write this check. Seed in the soil, not just on the trees. What I plan now, cause the legacy keys. Inbox chill, but I'm still in flow. Cash don't part just cause it's snow. Joy don't come from things I hold. It's how I give and what I grow. Talk stocks, I talk about structure. Talk sales, I talk about culture. Talk wealth, I talk about time. Cause what I sow now, my kids will find wealth. Give it, breathe it and ground it. 7-figure squad. We don't stop. We just thank God. Bright like balls, but cool like frost. Peace on lock, no matter the cost. We plan, we
Yo, bro, I could listen to that song over and over and over, man. Shout out to my producer here, Darian Clark Hay, right? Writing this song here for Merry Christmas to y'all. I don't know if I'm wearing this the right way, man. I don't know how you put this together, man, but welcome to another Tuesday, 2 p.m., Millionaire Responds. Merry Christmas to you all. Merry Christmas, Merry Christmas, Merry Christmas. Jesus is the reason for the season. So, right quick, guys, let's pause. If you own a home, if you have a family, if you have income, and you think, I'll deal with this financial stuff later, well, today's episode might be the most important one you hear all year. Because what I'm about to share with you in this episode is costing families, it's costing homes, businesses, and years of progress, especially when life happens. So let's get started. I got these things here. I got a whole bunch of episodes here, a bunch of reels, that I'm going to respond here starting in 3, 2, 1. Let's go.
Hey, 7-figure squad. Where we go? Run it up.
Before we get started, man, let me know what city and state or country, because we got a lot of people internationally now tuning into the 7-figure squad Millionaire Responds episodes. Let us know where you're hailing from. Are you calling from, or are you viewing from Chicago, from Florida, from the Philippines? Let me know. From Nigeria. We got a lot of friends in Nigeria. But welcome to another episode of Millionaire Responds. And let me be very clear, especially if this is your first time here. This YouTube channel, the 7-Figure Squad YouTube channel, it's about life insurance. It's about personal finance, entrepreneurship, protection strategies, basically making sure you got control. Don't talk about politics, no drama, no hype finance. We talk about real money that has real consequences in life with real planning and strategies. And today, we're locking that in. Now, over the last few weeks, your social media feed has been flooded with reels about Charlie Kirk's life insurance policy, especially with American Fest that just happened this past weekend, how the top 10%, how they actually save for retirement. So if you want to have a shot at retiring sooner than later, or retiring and never have to unretire to go back to work, how the top 10% do it. About bank accounts getting frozen at death. What? And families losing homes after health events. And then people realizing too late that their plan, that their hope strategy didn't work. Now we're going to cover different reels. Bottom line, it's the same truth, values, and principles. And most people don't understand how money actually protects their family when life hits. So today we're going to break down and tell you the truth. All right, first reel here. Let me make sure I cue it up here right quick. We're going to make sure we talk about this young lady who's got an interesting discovery. And a reel right now is circulating about Charlie Kirk. And we want to make sure that we see how this actually plays out in helping people understand how a large life insurance policy is tied to Turning Point USA. And because America Fest, again, this past weekend just wrapped up, this conversation is timely. But before all the trolls and the internet pundits runs this video wild, I want to make sure we bring clarity to what Charlie Kirk did, not conspiracy. So in this video, what's being discussed is what they call a life insurance policy exposure through a specific strategy. Let's take a look at this
Named
episode.
Brian Ferentz went through all of TPUSA's tax documents and found that in just 2023, a large life insurance policy was taken out on Charlie Kirk. As you can see here, GGLF LLC paid for a split dollar life insurance policy for the president/CEO of Turning Point USA, aka Charlie Kirk. Annual premiums for this policy are massive, $350,000 per year, meaning that the death benefit for someone who is 31 years old and a non-smoker would be between $20 and $50 million. All of this information is public because TPUSA is a registered 501c3 nonprofit. So you can go ahead and look up this information for yourself. GGLF 2023 LLC is also owned by Charlie Kirk. So why would he have one business paying one of his other businesses for his own life insurance policy? Because it's a common tax strategy for high net worth individuals that comes with massive write-offs and deductions, making sure that the beneficiary would not have to pay a massive estate tax of up to 40%, meaning on a $10 million death benefit policy, that could trigger a $4 million tax bill. Remember, in this case, the payout is supposed to be a lot bigger than that. The timing of taking out such a large policy so close to the date he was executed is interesting, considering this was far past the time that he had nationally broken out and become a huge public figure with TPUSA. It could, of course, be because he got married and had 2 children and wanted to make sure that they were protected in case anything happened. But that's making an assumption that we know who received this money. Even though this tax information is public, how much the policy paid out and who the beneficiary is private. Now, one would assume it's Erica Kirk, but if it was somebody else, that would be quite interesting. As always, I want to hear what you think.
Yeah, okay. Trying to stir the conspiracy there. So let me be very clear here what the responsibility of Charlie Kirk actually did. It's called a split dollar life insurance strategy. This is not new. This is not illegal. And this is not your traditional retail financial insurance strategy. Split dollar is an advanced insurance, an advanced tax planning tool used by founders, used by CEOs, used by nonprofits, and used by high income professionals. And so what it actually is, the simple version, is that a split dollar strategy is when 2 parties share the cost and benefits of a life insurance policy. Now, usually it's between an organization and a key leader, in this case, Charlie, or a business entity and its owner. And this is not insurance for death. This is about protection. This is about control, retention, succession, and obviously liquidity. So if a founder or an executive is the engine, the engine behind the brand, the engine behind the company. And the risk is you insure the asset, which is the person, the brand. Same reason corporations insure CEOs. And it's the same reason sports teams insure athletes. Why record labels insure their artists. Or why high performers get high-level planning. Now, let me address the elephant, okay? Because now all the life insurance pundits out there, all the buy term and invest the difference only crowd is out there. You've heard it. Cash value is trash value, because that's what this life insurance policy is. It's into a permanent cash value type of policy. That permanent insurance is a ripoff. Again, let me be clear. That philosophy of you just saying buy term, invest in difference is everything automatically disqualifies you from strategies like this. Because term only thinking lives at the basic fundamental 101 retail level. Split dollar, that type of insurance planning, lives at the institutional or high net worth level. Now, these strategies are specifically used for estate planning, is used for executive compensation, a creditor protection, accumulation, succession planning, liquidity without liquidation. So you don't use this to beat the market. You use this split dollar strategy to control risk, timing, taxes. And see, scripture says, the prudent see danger and take refuge. See, this is not speculation. This is great expression of financial stewardship. Now, again, if you have strategies like this and you want to know a more expanded version, put Kirk in the comment section. I can do a 5-minute, 10-minute breakdown of this. And by the way, we got other videos here like buy term and invest in difference type of reactions, or why is an index universal life policy a great alternative to the traditional qualified planning that's out in the marketplace today. We'll put some links here in the comment section below for you, or in the description below for you to check it out. But this here is not this conspiracy theory that Erica Kirk or Turning Point USA got rich off of Charlie's death. No, this is what responsible individuals do. Matter of fact, guys like Jim Harbaugh of the University of Michigan, when he was a head coach over there, had a split dollar strategy. If you just Google Jim Harbaugh, split dollar, University of Michigan, you'll see that this is not a uncommon strategy, especially for those that have income levels or high net worth type of situations. This is an insurance strategy, not some form of conspiracy hype for a Turning Point USA or Erica Kirk get a lot of life insurance money. All right. Now let's turn our attention to this article. Speaking of how the top 10%, and this one is a Investopedia article that allows us to see what the conversation is about how to save like the top 10%. So let's take a look at this article right here. This is not a video. I'm just going to go over this article with you guys. Ooh, what the happened? What happened to the article? How do we go back to the article? Let's see if I can pull it back up on my Chrome. Investopedia. Here we go. Here we go. All right, let's go back here. So here's a couple of things. This is the article right here. The surprising amount the top 10% has saved for retirement. So most people, when they look at this, right, they look at this article. Let me just fast forward here through this. Okay. A lot of people look at this and they say, okay, this is great. This is how life insurance and Roth IRAs and IRAs operate for the rich. You know, I always like talking about habits and systems and structure. People say, you know, the wealthy, man, they see the gap and they say, wow, they just saved more money. But that's not the lesson. Who this is for, and let me be very clear, if you're earning $20,000, $50,000 of household income, if you're earning $300,000 as a W-2 employee plus, $300,000 plus, if you're earning $400,000 as a business owner, or you're on track to, this conversation and analysis of this article is for you. At this level of income, the system flips. For example, Roth IRAs phase out. In other words, you have so much income that you have what they call a phase out, and contribution limits stop mattering. Whatever you put in $7,000 for this year, it stopped mattering as this income barrier that you're starting to break through starts to allow you to have great opportunities in America from an income standpoint. But the contribution limits of a Roth IRA, they don't matter anymore. And taxes quietly become your largest expense. You don't have a motivation problem for those of you that are watching this. You have a structural problem. Now, this article explains that the top 10% do not rely solely on 401ks and IRAs. Okay, let's go here. Okay, where is it? Here in this article. Okay, the retirement strategies used by the top 10%. Retirement strategies employed by the top 10% differ drastically from those of the average American. Their significantly higher savings reflect having a higher income, more proactive and strategic approach to retirement planning. Okay. The top 10% don't just save money, they use advanced financial strategies to grow and protect their wealth. They're proactive about leveraging tools that offer tax advantages and long-term growth opportunities. Okay. When they're looking at high net worth individuals, they tend to leverage backdoor Roth IRAs, which are ideal for those who exceed income limits. In other words, the more money you make, God bless you. But that doesn't mean you can put your money here into Roth IRAs without having to do a specific strategy called a backdoor Roth IRA. Right? The way it works is that high earners bypass income limits by contributing to our traditional IRA. Okay. And then you convert it into a Roth IRA. And it's just simple paperwork. But what that does, it triggers a tax consequence. This strategy enables tax-free growth and withdrawals in retirement. But again, you have to understand when you contribute to a traditional Roth IRA, and you backdoor, you convert it to a Roth IRA, that triggers, for example, if you had a 401k and you roll it over into an IRA and you convert it to a Roth IRA, whatever balance you have inside that rollover 401k into a rollover IRA, and you convert it, that now triggers whatever balance you have in there is now added to your gross income, to now your adjusted gross income. It triggers tax. I don't think this article talked about that. They also use cash value life insurance, which can be used as a tax advantage accumulation vehicle, and taxable investment accounts with tax loss harvesting, which can be used for building wealth that is in liquid accounts for life before retirement age. For example, tax harvesting means that certain stocks you might have in your portfolio, you suffered capital losses because of that bad stock or the stock holding, whatever, and it's not recovering for this year. Okay. And towards the end of the year, you sell it. And what it does, it triggers a 1099 that you can use to offset the gains or your income from you can offset the capital loss from the capital gains. But here's the thing. Once your income rises, the rules change. Now, here's where life insurance comes into play. Because a lot of times people say, well, if I'm high net worth individual, I'm self-insured. Well, Investopedia even mentioned, this article even mentions that high net worth households use life insurance as part of their retirement strategy. So for the average person in multicultural middle income demographic, term insurance is definitely a play. We make sure everybody has at least a term insurance policy. I'll give you an example. This past Thursday, I was just with my business partner, Chris Hart and Vicina Hart, at their Christmas party in Washington, D.C. But this past Thursday, one of their licensed associates left the meeting early to go help a friend who needed a jump, who was pulled over on the side of the highway. Sadly, it was late at night, an irresponsible driver didn't see them, sadly, crashed into the car that was pulled over on the side of the road getting jumped, and this insurance agent / part-timer, sadly, got killed. But thank God he came into our environment. Thank God he came into a mentorship group that we offer through our national agency, where he can level up his financial literacy, get licensed, start earning money with us on a part-time basis without stopping his college education, without stopping his full-time job, and get literate with what is going on with financial strategies and insurance strategies. Sadly passed away. Worst part, expecting twins. Now, sadly, he's not here. It's tragedy that he's not here. But thank goodness he had a conversation about getting both a term policy and a permanent policy. And instead of just us offering prayers and condolences, we're offering his family a tax-free check that financial control is still in order for them, that his twins, even though he's not here with us, God rest his soul, Faith, that he can still make sure financially provide for his twins and his family. And we had a daughter one time come to our office and say, this is the way my daddy sends checks from heaven. And so back to this article. This article is not talking about your basic term policy. It's talking about a permanent policy. This is cash value life insurance, where cash accumulation can grow inside the policy, because it offers things, qualified plans like a 401k, like an IRA can't, such as no income-based contribution limits, such as tax-deferred growth, such as liquidity to that cash without early withdrawal penalties, like under 59.5 withdrawal penalties, no required minimum distributions that you're forced to take this money out in your 70s. At the same time, too, there's estate tax efficiency to go from one generation to another. So this strategy here is just not about returns. This is about control. So if you want more control in your family, you have to address risk management in your insurance strategies at every step of the way. All right, let's get into the next. Speaking of control, did you know that your bank accounts can be frozen when you die? Now, let's talk about a reel that scared a lot of people, and rightly so. They said, if you die, your bank accounts get frozen. Well, that part is true. And as we review this reel, let's unpack it as we watch this together. Let's take a look at this.
Only in your name and you have no payable.
Let's start from the beginning here.
Die today, this is exactly what would happen to everything that you own. If you have a bank account titled only in your name and you have no payable on death, frozen, your family will not have access to those accounts until the court gives them permission. What happens to your house? If you are the only one listed on the deed and there is no right of survivorship and your state does not recognize the transfer on death deed, probate. Your family could wait months and even years before getting ownership. And if they don't have enough money to cover the mortgage because they can't access your bank account, foreclosure. Banks do not care. Do you still have rental properties titled in your personal name? Probate. And no asset protection. Do you have a business? If your business interest has not been assigned over to a trust, probate, retirement account, no beneficiary or the wrong beneficiary, the court will decide if your forms are correct or not. Brokerage accounts, Robinhood, Schwab, Fidelity, these accounts do not automatically transfer. No beneficiary means probate. Life insurance. If you have your minor children listed, they will receive a lump sum at the age of majority, which means that their inheritance will not be protected from creditors. Here's the truth. If your assets are not structured properly to transfer on your death, they will go into the court system. Your family waits and your family pays. So what is the solution for people who have assets? Number one, create a trust. Number two, retitle all of your assets to the trust. And number three, name your children as beneficiaries of the trust. Okay, I'm just going to be blunt with you. If you were to die today, this is exactly what would happen to everything.
All right, well said. Well said. Well, this part is true. Okay, enjoy what you said is true. Let me just explain a little bit more because I know she kind of quickly went through it. Some of the jargon. So, for example, probate is when the court steps into your family affairs. POD means payable on death. No POD, the bank lacks the account. She talked about right of survivorship on a home, which means that the house transfers instantly. If there's no survivorship, probate comes in while the mortgage is still due. So here you are as a family member, you're paying the mortgage, but the probate court comes in and they're starting to rule things regardless if you have debt on it or not. So what gives it instructions are trust. For example, I'll give you the list here because we just did this on Sunday night call, and incidentally, it's just been right here at my desk. Here is an example of my life insurance policies. This is just a handful of them, okay? There's a life insurance policies here on all my three children. All right, all my three children, my three older children. We have two more here and the younger children. This is one of my policies that I gotten back in 2003 from a company called Indianapolis Life. This is a policy I got from Nationwide. What was the date? What was the date on this policy? Date on this policy is 2013. The company got another policy with a base out in Canada. Foresters is another insurance policy I got. Oh, here's all my durable powers of attorney. Do not resuscitate, assignment, and nominee agreement. All these different things here I've got inside this trust, affidavit of trust, because I was a single father and I need to adjust certain things. These are memorandums. By the way, this is all easily accessible to my family. They know where to find this because something happens to me because I travel quite frequently. They know exactly where to find it at my office. And we were just talking about this the other day. Here's another Nationwide policy this is AIG policy. I got a ton of life insurance here. This is my former trust. I say former because this is me as a single father. This trust is established 2004. So these things I've established throughout my life for the last 20 plus years, and understanding that it's one thing to get assets, it's another thing to get trust, but how do they work together? Because trusts give instructions. However, trusts don't create cash, which means families can be asset rich and cash poor. In properly structured life insurance policies, they bypass probate, it pays fast instantly, So in other words, as soon as you submit the death certificate, the insurance company, make sure everything's all good to go and squared away, nothing crazy. It happened to the death outside the promises of inside the contract. No, what's that? What's the word I'm looking for? Conspiracy, all that crazy stuff. Life insurance, for the most part, for most people, as soon as you have a life insurance policy is in force, you've been paying your premiums, boom, submit the death certificate, they're going to be issuing you that death benefit. It also pays privately. That's why, going back to our Charlie Kirk reaction, we don't know specifically what the death benefit was. We can only assume based on his age, we can only assume based on the premium they were paying over $300,000 a year, what the potential death benefit might be based on these life insurance companies' cost of insurance tables. It also depends on if it was a universal life policy, a whole life policy. Could have been a variable policy. We don't know. Could have been a blend of term. We don't know. But the beautiful thing about life insurance policies and trusts working together, it does create immediate liquidity. We all know this, Proverbs 13, right? That a good man leaves an inheritance to his children's children. That's your generation, your children's generation, and your children's generation. That's 3 generations. And inheritance means when it's needed, now, not years later. Salute to her, doing a good job with, what's her name? The Real Lawyer. Salute to you, good job. All right, the next video here, speaking of having assets, having life insurance, lots of times people think that life insurance is just something that you get paid when you die. But imagine if you can use your life insurance to pay your mortgage. Let's take a look at this TikTok.
Your mortgage? It's totally true. It's called mortgage protection insurance with living benefits. So how does it work? In the event of death, it is designed to cover the homeowner's mortgage. And in addition, it has a living benefits coverage. If you become critically ill or disabled and are unable to work, the living benefits coverage allows you to get up to $250,000 tax-free. That could be the difference between you losing your home. This is a life insurance, not a home-related insurance. The application process is quick and easy. You don't need a medical exam and you don't need an in-person visit. Take the first steps to protect your family in case something happens. Click to learn more. Did you know that you can get life insurance to...
Okay, by the way, I love this. Who's this creator?
Did you know that you can get life...
Good job. Find my policy today on TikTok. Good job. I love this one. Because this is one of the most misunderstood and most powerful uses of life insurance today, which is living benefits. And life insurance today isn't just about dying. It's what happens if you live. What happens when your health changes. For example, heart attack, stroke, cancer, and you survive. You know, I remember last week, there's a guy in my workshop, and he says, listen, I found that I had prostate cancer at 25 years old. That was 11 years ago. And he showed me where it metastasized. The cancer went to his brain. They had to get in. He had a big scar in the back of his head. I said, listen, brother, if I knew that this type of life insurance policy would be around, I'd have cash today, not brokenness today. Because here's a reality check. When health changes, income for most people often stops because they're not rushing to run back to work. They're definitely not looking to run their business with all the responsibilities they have. But what doesn't stop is the mortgage payment. And living benefits allow families to access money, liquid cash, while they're alive. They survive this heart attack, stroke, or cancer. It's in order for them to keep the house. And I can tell you, my national insurance agency, we help families with this every single month. There is always a claim in our agency every single week, every single month. People that survive serious illnesses like heart attack, stroke, and cancer. I can't tell you how many people in their 30s are suffering strokes today. But thank God we run across them. We get them financially literate. We get them financially educated so they can make a business decision to make sure they lay the financial foundation, the financial fundamentals of building their financial house. So therefore, they don't lose their home when the winds of life come blowing by. Because had more people had the right coverage, more people wouldn't be losing their homes to foreclosure due to a change in health. And this is exactly why I wrote the book, Keep the Keys. Because for homeowners and real estate investors, losing property rarely starts with bad intentions. It starts with a health event. It starts with an income disruption. It starts with no cash liquidity. So in my book, Keep the Keys, we cover real case studies. We cover living benefits. You want to put up the thing? And we also cover the 7 insurance strategies every homeowner and investor should know. Now, you can get these free tools and checklists at my website at keepthekeysbook.com. Free. You don't have to buy the book. Get a couple of worksheets we have there via PDF and email. You can see the clarity charts. If anybody ever tells you got to put your money here, you got to put your money here. Great. Put it through the clarity chart. Put it through the clarity filter. Okay? So therefore, you can make a more educated and logical decision about where to put your money, where to properly steward your finances based on a little bit more logic and less emotion. Because here's what I know about decision making. When logic is low, emotion is high. FOMO sometimes kicks in and, oh, am I doing the right thing? Am I being left behind? Or is this stupid? I got to do it, right? And usually when logic is low or education is low, emotion is high. And you hope that you make the right decision. Hope is not a financial strategy. However, when logic is higher, guess what happens is lower? Emotion. You're able to stand on business. And so as I close off today's episode, and as you look at this, if something I said today stirred something in you, that's not fear. Hello, that's awareness. And if this helped you, please share it because someone you know might be one bad day away from a financial disaster they didn't see coming. I appreciate you for tuning into this episode of Millionaire Responds, where we don't just talk about money, we talk about protection, we talk about stewardship, personal finance, legacy, and overall making sure you have control. If you haven't done so yet, make sure you hit like, share, and subscribe. And I'll see you next Tuesday. Please put your biggest takeaway in the comment section below. I'll see you next Tuesday, 2 p.m. here on the Millionaire Responds on 7 Figure Squad. That being said, guys, God bless you. Merry Christmas. Again, He is the reason for the season. Happy early birthday, Jesus. That being said, guys, until we meet again, continue smart, be money smart today.